We're calling the session Are Trade Wars Class Wars? And our first guest will be Matthew Klein, an economics commentator for Barron's and an author of a book that is just like the session title we have, but without the question mark. He and Michael Pettis recently published Trade Wars Are Class Wars: How Rising Inequality Distorts the Global Economy and Threatens International Peace. He'll be joined by Kathy Feingold, Director of the International Department at the AFL-CIO and Deputy President of the International Trade Union Confederation. Welcome to you both. We will be hearing from our two guests and then have plenty of time for Q&A. If you have a question, raise your Zoom hand, the little green button on the bottom of your screen, and we'll give the microphone to you. You can also put a question into the Q&A text function, and please tweet today at #NPFTrade. So Matt and Kathy, thank you very much for joining us. We're excited to have this conversation. It's kind of a big concept discussion. You know, we love to get people talking and thinking about trade, and this is kind of a discussion of the broad trends of trade and how it's affecting the working class. So we will go to Matthew first. So Matthew, welcome, and looking forward to hearing from you and hearing about your book, which we have right here, and I'm sure you can buy at your favorite online retailer. So Matthew, welcome, and looking forward to hearing from you.
Thank you very much, Chris. Thank you for having me. So I'm just going to do a quick sort of summary talk of the main arguments of the book, and then hopefully that'll lead to a worthwhile discussion. So, as we said, the book is that we put the thesis in the title that trade wars are class wars. And the reason we frame it this way is that it's very easy to think of economic conflicts as being between countries, that it's either about sort of geopolitics or incompatible national interests or differences in cultural characteristics. And our argument is that that's not right, that it's actually much more useful to think of the global economy as a single system that's connected through trade and finance, and that issues in one part of the world will affect people in other part of the world through those channels. And it's very easy to misinterpret that as country versus country when it's really economic class versus economic class. So, there are sort of two common wrong views that are very common when it comes to trade that we've seen both, especially in the past few years. One is sort of just a caricature that names a little bit, people who say everything was just fine, that, trade doesn't actually affect domestic conditions one way or the other. You can call these globalists or what have you, that, it's not appropriate to think about trade as being either as ever causing problems. And then the other sort of opposite extreme view is that everything that's a problem is because of foreigners, and that, that foreign governments are taking advantage of people at home, and that's the issue. And our view is a little more subtle and actually goes back over 100 years to a British economist named John Hobson. And I'm not going to read this quote, but the argument that he made at the time was essentially that the conflicts, what it looks like conflicts between countries are really a function of the fact that the very rich, they have, when they have too much income, relatively speaking, or too much of a share of national income, that distorts the way the economy works, and that leads to pressures to create trade conflicts with the rest of the world. And in his view at the time, this was one of the explanations for European imperialism in the late 19th and early 20th centuries. And then subsequent thinkers, most recently Kenneth Austin, who used to be at the US Treasury, have applied this to understanding the modern period of basically, the 2010s and the 2000s, and with different sets of countries involved. And so, to understand this argument, because it's not necessarily very intuitive, it took me a long time to understand it. And, my co-author was Michael Pettis, is very helpful. Why does inequality actually matter? And there are a lot of reasons why people might think inequality matters, and other people have written about this, whether it's, questions of fairness and incentives and so forth. And I'm not going to talk about that, but there's a very simple argument why it matters, which is that people and economic entities that are very, very rich or very high income, they behave very differently from everyone else. So most people over the course of their lives will spend essentially everything they earn on goods and services. And when you spend on goods and services, you end up creating income for someone else. So all income comes from someone else's spending. All spending is ultimately coming out of income or change in debt. And so the difference is that people who are very rich, and you can see this on the chart on the right here, they save something close to half their income. And the reason, of course, is that there's only so much you can spend on goods and services. You might be incredibly, have very, very lavish taste, but at the end of the day, you can only have so many, $1 million birthday parties per year. The rest of it, you're going to be, buying assets, whether it's financial assets or real estate. And the flip side of this is that if you're buying those assets, someone else has to be selling those assets. And so what in general this means is that shifts in the distribution of income lead to shifts in borrowing and debt. And so a lot of economists have found this over the years in different places and in different times. But if we think about globally, the problem that's occurred over the past sort of 3 or 4 decades is a sharp change in the distribution of income. That was been made possible. It was necessarily coincident with a big increase in debt. And so, the chart on the right is just showing it for the United States, but you can see this. There are a lot of academic papers showing this for other countries as well, and you can see it in the 1920s as well. So this is a well understood phenomenon that when the top income share rises rapidly, that you're going to have that offset somewhere else, because they wouldn't, how would they keep earning money? How would corporations keep generating profits without sales? And the reason is that people who are losing out are making up for their lack of income through borrowing. And you can see that in the chart on the left. Okay, so now let's look at some specific countries to some concrete examples here. And so in the book, we talk really about we talk about a lot of countries, but we focus really on 3 in particular, because they're sort of the major global economies. And between them, they're representative of a lot of what we've seen elsewhere. And the first one is China. And, there's a lot of stories about what's happened in China, and there's a lot of nuances we can take. But I think one thing that's really important to understand is that basically after 1989, the Chinese economy underwent a significant shift, that the political economy was such that regular Chinese households and workers ended up losing out pretty dramatically to, we call them elites, but you can think of them as whether they're provincial officials or people connected with state-owned enterprises, or rich people who end up being affiliating with the Communist Party, and also the owners of multinational companies that set up operations in China. And so one way to see this is on the chart on the left, which essentially is showing, okay, of all the value that the Chinese economy is producing, the workers, the businesses, the machines, and so forth, how much is going to households who are actually buying things that make them happy? That's the blue line. And then how much is going to either business investment or net exports? And net exports essentially is you can think of that as what they're giving to the rest of the world in exchange for some kind of financial claim. And what you can see very clearly is there's a big shift starting in 1989, where households are earning progressively smaller shares of China's national income, and it's instead being redirected elsewhere. Now, Chinese households, if you were to ask them, which we can't, they probably would say that this is not necessarily a problem because their overall levels of income are rising so rapidly, but it's nevertheless the case that if China's overall production is growing at, say, 10% a year, and household spending is growing at 6% a year, you can see that, that would lead to a big difference. And, this is particularly important more recently as China's overall growth has slowed down, that China's household consumption has also slowed down with it. So even though China's, you see a little bit of a increase in the blue line starting around 2010, it's still extraordinarily low. So for some context here, for a large economy, that's basically unprecedented. I think the only time you can see in a sort of a large diversified economy where household consumption is that low as a share of a domestic production is basically Stalin and the Soviet Union, when you had people starving to death so they could generate grain exports to fund industrialization and trade with the Nazis. Now, China's situation is better than that in terms of household living standards, but it's still an extreme kind of situation. And if you look at other countries in the world that have that, it's basically either corporate tax havens where the numbers are sort of not really reliable, or oil sheikdoms when the oil price is high. And again, that's not really representative of the Chinese situation. And so what's the consequence of this? The consequence is that if workers aren't being paid well enough, which is the key point here, then you're going to have a situation where companies are generating a lot more stuff than people can absorb domestically, and that excess has to be sold somewhere else, and that's where we get the trade conflict from. So, if globally, the problem is that more stuff is being produced than is being able to be absorbed domestically or being absorbed by people in the world as a whole. The difference comes from borrowing, but those specific imbalances are different in different countries. So some countries might have the inequality, some countries might have the debt, some countries might have the excess production. That shows up through trade. That's where these conflicts come from. So in China, what you had basically before 2008 was there was no real meaningful increase in debt within China, but there was debt in the rest of the world, China's trade partners. Since 2008, China has also increased its indebtedness, but nevertheless, you still have a situation where China is just producing more and more excess sent to the rest of the world because Chinese households aren't consuming. So that's a situation in China, a very different set of situation in Germany, but nevertheless,
Matthew,
the end result is kind of,
yeah, sorry to interrupt, but I just had a question. somebody
Of course.
posed to me, if you could go back to the China one.
Mhm.
There's basically two periods in which the red line goes up and the blue line is correspondingly drops. One looks to be around the 2000s and one's in 1990. I mean, what
Yep.
are there similarities? What's going on at those two time periods? Are there similarities? What are the broad changes underway at that time?
So that's a great question, and we talk about this in more detail in the book. But essentially, if you after 1978, when China abandons sort of the Maoist way of operating, and there's a significant amount of liberalization in the countryside, you have rapid increase in productivity growth, and that's leading to rapid increase in living standards. But the unevenness of the liberalization between the countryside and the cities is such that you end up, by the end of the 1980s, you have these rapid increase in food prices, and that coincides with rising demands, popular demands for more democratic governance. The regime, cracks down quite violently in 1989. You have essentially a rollback of political liberalization and the adoption of essentially a different kind of political economy that's much more state-directed, much more heavy-handed, and that coincides with the shift in the early 1990s. And then in the 2000s, you have, for slightly different reasons, but kind of similar, which is that you have this big increase in debt in the 1990s in the Chinese banking system. And the way the government chooses to deal with that is basically they bail out the banks by essentially harming household savers. So at the time, you really didn't have, if you were a Chinese person, the only way you can save money is by putting a bank deposits in the bank. And if the interest rates on those deposits are just extraordinarily low relative to the returns that you ought to be earning from the real economy, and then the banks make loans to companies at low rates but higher than the deposit rates, and the banks will get bailed out, and companies will get basically cheap funding. So it's effectively, that's a way, and my co-author Michael Michael Pettis is really the China expert here, and he's calculated that process in sort of the first half of the 2000s, it was equivalent to basically a tax and transfer from ordinary households to big companies on the order of sort of 3 to 5% of Chinese GDP every year. So it's very, very large. That stopped around sort of 2010, 2012. And you can see that sort of coincides with the end of, the bottoming out of the blue line, but it wasn't enough by itself to really reverse kind of the accumulation, because there are a lot of other things, labor rights in China, basically, adversarial labor unions in China are illegal. You have a situation where a large proportion of the urban workforce are because of the way that China's household registration system works, which is sort of a relic of the Maoist era, people are treated essentially as illegal immigrants. They're not able to qualify for things like housing benefits or healthcare or education, even though they pay the taxes for it when they're in the cities, and they can theoretically be deported at any time. You have situations where land is essentially can be confiscated more or less at will by local governments to give to businesses. So there are a lot of these factors that contribute to the suppression of household incomes, and that in turn lead to lower household consumption. And the extent that the Chinese government hasn't addressed most of those problems, despite having said that they recognize that these are issues, that explains why household consumption is so low and why it's such an outlier compared to the rest of the world.
Okay, got it. Thanks.
And just to be clear, while it's very easy to associate these kinds of developments with undemocratic regimes, you can also have these kind of problems in democracies. And so that's why the German and sort of broader European example is very interesting. And so Germany, I think, is really fascinating because the sort of common story you hear about Germany is that the reason that Germany has a trade surplus is that German exports are just very competitive, they're very high quality. And that just does not make sense. I mean, they are. I mean, I have no problem with that. I mean, I have a Miele vacuum, and it's wonderful, but that's not really why trade surpluses arise, right? Trade surplus is the difference between exports and imports. If you're good at making exports that people want, the reward for that should be higher living standards at home because you can buy more things. But that's the opposite of what's actually happened. The reason why Germany has a trade surplus is because their import growth has slowed very dramatically since about 2000. The other way we can think about this is that if you look at it, and I don't have this chart here, but if you look at a longer history of Germany's trade balance, basically since the end of World War II, it was basically flat. It was either a small surplus or flat through that entire period, or actually slightly in deficit in the 1990s. And then recently, basically since 2000, you have this massive sustained trade surplus. And so is that a function of German cultural characteristics? Probably not. Did anything change meaningfully? I don't think so. Is that a function of, did the quality suddenly improve? No. In fact, if you look at just the growth rates of German exports, the growth rate of German exports since 2000 is much slower than the period when the trade surplus was rising than it was in the 1990s when there was no trade surplus. The difference came from imports. And you can see this in the chart on the left very clearly, which essentially is that German domestic, in the early 2000s, you had a very severe recession in Germany as a consequence of the tech bust and a consequence of other things. And imports fell as a consequence because imports basically tracked, domestic consumption, household consumption and business investment. German companies that exported, their growth was still relatively weak because there was a global recession, but nevertheless, their sort of exports just rose in line with overall, demand in the rest of the world. And that opened up a big gap between, the blue and the pink lines there. And, one way of thinking about, the same thing is that German companies responded to the recession that they had, or alternatively, you could say they created the recession, but they cut business investment at home. They cut worker pay, both by laying people off and by reducing hourly pay and essentially shifting the balance between capital and labor. And nevertheless, they were able to maintain their sales because people in the rest of the world were still buying their stuff. And so, the German corporate strategy would not have worked if everyone in the world had tried it at the same time. It worked because people in the rest of the world were willing to borrow to buy German goods. And so, one way of looking at this is the chart on the right in terms of who's benefiting from Germany's trade surplus, which is that if you look at the change in the trade balance since the early 2000s and the change in the technical term, the net operating surplus of German businesses, they match quite closely. So essentially all the gains went to German companies that either they were using to pay down their debt or retain earnings for their shareholders. Often these family-owned businesses, which is a quirk of the German system, they don't have to pay inheritance tax if you pass down a family-owned business. It's a very strange system. So obviously, you have a lot of rich people creating, holding family-owned businesses and then keeping money within the family-owned business to avoid paying taxes and passing money on down to their heirs. So this is a situation that's clearly not good for Germany, people in Germany, and it also has consequences of the rest of the world. Now, this ended up spreading to Europe over time. So before sort of 2010 or so, the bulk of Germany's excess production, or alternatively their underconsumption, was offset by behavior in the rest of Europe. And so you see that for Europe as a whole, household consumption and total production of businesses basically matched pretty closely until about 2010, which makes sense. The reason we have an economy, broadly speaking, is to sustain household consumption. Like that's the point. We want to be able to improve our own living standards. If you're producing things that you aren't consuming, then there's a problem. You see that breaks down starting around 2010. And the way to think about why that happens, you can see in the chart on the right, which is that Germans sort of the underconsumption, or alternatively the spending too little relative to how much they are producing, that's sort of the dark blue column. That was offset by sort of the opposite development you see in places like Spain, Italy, and Ireland, and Portugal, and the Baltics, places where you had very large increases in debt, mostly household debt, before the crisis. And so the result was that Europe as a whole looked like it was in balance. The problem is that then you have the euro crisis, and suddenly for a variety of reasons, the ability of those countries to access borrowing markets was cut off. And so rather than having a situation where Germany and then the Netherlands, which had some similar behaviors, essentially spent more to offset the decline in spending in Spain and Greece and Italy and so forth, you didn't have that. It was a very asymmetrical adjustment. So you just had this massive decline in spending in the crisis countries, and that led to a big shift overall in Europe's position. So you can see the big gap in the chart on the left opening up between production and consumption, and that's where you end up with Europe with a very large trade surplus. And so you can see there's the change in Europe's trade balance since about 2010 or so is purely a function of the fact that spending, both household consumption and in business investment and public infrastructure investment, and public service provision in the Euro crisis countries just collapsed and has basically stayed down. The idea that there was an increase in competitiveness, which you sometimes hear if you talk to Europeans, is just not true. It's true that Portugal has managed to do relatively well in boosting their tourism exports, but other than that, the reason why you've seen this massive change is purely a function of depressed domestic spending. And so again, you see a situation where large swaths of people have become poor, than they otherwise should have been. In fact, inequalities increased quite dramatically in a lot of these countries. The social safety net has been shredded in a lot of these countries, which is something you also saw in Germany in the early 2000s. So they're all worse off. And the rest of the world is worse off too, because suddenly you're in a situation where there's less spending in Europe, and so that has to be offset somewhere else. And so that leads me to the sort of the last section here, which is looking at the United States. And the United States is not unique; it's the biggest country that faces the situation. But it's really actually, if you look at sort of all the sort of English-speaking advanced economies, Canada, Australia, the UK, you see broadly similar patterns. And there's a reason for that, which is that the financial systems in these countries are very accommodative of this, and legal systems. But essentially what you see is that the underspending in the rest of the world is offset by either rising debt in the Anglosphere, or alternatively by lower production, both of which are harmful. So we can sort of talk about which is more harmful and what's the context of this. But one way of looking at this is the chart on the left. We can see that U.S. manufacturing production of durable goods, which include, that could be steel, that could be semiconductors or cars or airplanes. I mean, it's a whole range of things, but generally you can think of as sort of, more advanced manufacturing. And it used to track domestic consumption reasonably well. And that breaks down around the year 2000. And again, we talk about in the book a lot of the things that sort of changed around that period of time that lead to this. But what you can see is that the gray line, which is the actual production, is more or less been flat. It's not completely flat, but it's more or less flat. And it really doesn't track at all the increase in domestic demand. So, the extent that the U.S. economy did increase its demand for manufactured goods pretty substantially over the past 20 years, but not its production, that incremental demand was met entirely by imports. And, one way of looking at this, or thinking about this a different way, is, that means that there must be some, significant change in the financial position of various entities in the U.S. economy. And so you can break down the trade balance essentially into, who's doing what. You think about governments, business, households. And what the chart on the right is showing is that, crucially, it wasn't actually the government budget deficit that was the big driver of this. The big decline in the black line between sort of the mid 1990s and the mid 2000s, that was driven by, on the one hand, in the sort of second half of the 1990s, you have the U.S. corporate sector, business sector going this big sort of investment binge, which didn't quite. Some of that may have been justified because of tech advances, but some of it was clearly not. You can think about like Enron and WorldCom, and all those companies ended up going bust as a consequence of overinvestment and over borrowing. And then in the early 2000s, you have a situation where households, I think we all remember the housing debt bubble. That was sort of the offsetting factors. So you had people using homes and borrowing against rising home values as a way to offset stagnant incomes to maintain a standard of living. And it wasn't a situation where there was some massive consumption boom. We talk about this in the book, but essentially what happened was that, consumption actually grew more slowly in the US in this period than it had before, compared to sort of a long-term average. But income growth was so weak that you needed this debt essentially in order to sort of keep things more or less what people were used to. And it wasn't, even then it wasn't enough. But that was also very unstable, and then you had financial crisis. So again, tying this all together, if there had been more spending in the rest of the world, if there'd been a different distribution of income in the rest of the world, there hadn't been these changes that we describe in our book, which would go into more detail, that had, and people had more spending power. Consumers had more spending power globally out of their income. They earned more and had more spending power. Then overall demand for goods and services would have been higher, and incomes would have been higher. There would have been less need for debt, and there would have been more employment. And overall, people both in Europe or in China, in the United States, would have generally been better off. And to understand why we now see these situations where Americans are saying, oh, Chinese are taking advantage of American workers. That's not right. It's that Chinese elites and American elites essentially cooperated against the interests of American workers and Chinese workers, and both suffered, but in different ways. Just as we can look at what's gone on in Europe and say, oh, those crafty Greeks or whatever took advantage of German savers, or alternatively, oh, those awful fascist Germans are imposing this austerity on poor Italians. That's not the right way of thinking about this. The right way of thinking about this is that the sort of the rich elites across European countries came up with a system that worked relatively well for them at the expense of workers in Germany, in Italy, in Greece, and so forth. And that's been bad for the vast majority of people who live there. And so hopefully, as we sort of explain how this works, we can get people to change that. But that's ultimately going to be a political and political process, and it requires changes in sort of the bargaining power of workers, and how they relate to businesses and managers and investors. And so I'll be really interested to hear from Kathy about her actual practical work in that field, as opposed to just my sort of reading about things and playing with data. So thank you.